Welcome to the Expert Exchange. I'm Lindsay Melchuk. The Bank of Canada has just delivered its latest rate decision, holding the overnight rate to 2.75%, ending a run of 7 consecutive cuts. Now, alongside that move, the bank also released its monetary policy report, offering a new range of economic forecasts and a deeper look at how it's navigating persistent inflation pressures and rising recession risks. My super co-host Michael Sakuro from Spark Financial joins us now to break down what this means for markets, investors, and actually the broader economic outlook. Welcome back, Michael. Here we go again.
Thank you for having me, Lindsay. Well, today was definitely not really a shock. It was more so expected. But what a whirlwind it has been. You know, if you talked to us 3 weeks ago, we were saying, yes, there's going to be an emergency cut, maybe 0.5, 0.75%. Then last week, we're looking, okay, maybe a quarter point. And then this week, as we started off the week, it's like, okay, yeah, I think they're definitely going to hold. Now, what was great was we saw inflation came down from 2.6 to 2.3%. And we were hoping that also with the elections around the corner, the government that's currently in power wanted to make a great move and hopefully cut the rates to help first-time home buyers and help current homeowners and hopefully generate some more votes. But surprisingly enough, they held the rates today at 2.75%.
I mean, well, this is a pivotal moment in Canadian monetary policy. With that hold, there's a decision that was made there. And so the markets are split. I mean, inflation, if we talk about this, inflation's sending mixed messages. And there's a ton of trade uncertainty that's adding more noise to the signal. So what's your takeaway from this?
The take right now is like you said, there's just too much noise. A lot of people don't have their blinders on. There's a wide scope. And when we're speaking with potential first-time buyers or clients that want to either downsize or upsize their properties, they're all holding right now. They wanted to wait for today and see what was going on with the rate announcement. They want to wait till the 28th, see what goes on with the election. And on the broader scheme of things, they want to wait and see what's going to happen at the end of the month. Are there going to be new tariffs, another tariff hold, or whatever may come to play with the global economic market. So there's 3 contributing factors that are really causing some uncertainty in the market right now. That really has it at a standstill that I've really seen, especially the last month.
Okay, so let's push this. All eyes right now are on the BOC, not just for the rate call itself, but also for the tone of the monetary policy report. I mean, with inflation softening to 2.3%, but core metrics like CPI median still near 3%, the bank's facing a credibility test. So they chose to stay cautious and hold at 2.75% and not risk another 25 basis point cut to even cushion the slowdown, especially with trade pressures mounting from US tariffs. So this isn't just a rates decision, it's a signal on how much economic slack the bank believes Canada can absorb before inflation risks re-emerge. What do you think?
Yeah, it's definitely their test on the market and test on the Canadian creditors. But I feel that it might have been the wrong move or may be the wrong move. We don't really know for sure. We don't have the crystal ball in our hand. But I feel that a lot of Canadians are struggling right now. Cost of living is still very high. Salaries haven't matched that. Affordability is definitely not there right now. And I think Canadian consumers, Canadian home buyers, and current homeowners need every cut they can get when it comes to these rate announcements. It's crucial for survival in this current financial landscape, especially if you look now, our next rate announcement is not until June 4th. So that's 2 months now almost that they need to worry again with the renewals that are coming up or anybody that's looking to buy a property. The great thing is the rental rates are coming down for anybody that has to renew any rent or maybe look at any different properties they have to move into. But for those people that are just desperately trying to hold on with their current renewals that are coming up or anybody that's just trying to enter the market, this really puts us at another standstill, I feel, for at least the next 2 months.
Okay, so then let's talk. The NPR didn't just support that hold, it reframed the whole conversation. By ditching point estimates in favor of forecast ranges, the bank sent a clear message. The path ahead is murky, and it's not pretending otherwise. Let's be honest here. So most were, like me, were expecting a hold, but the red line, the real headline, it comes down to the tone. Less recession panic, more controlled recalibration. So markets were bracing for a full-on dovish pivot, but the bank might have just pumped the brakes on that narrative a bit. So my question to you is, does this shift the playbook for investors, or is this just smoke and mirrors? I mean, what were you expecting?
I was expecting a partial cut. Reason being is, again, being boots on the ground, the uncertainty with a lot of home buyers, but also more so the fear of a lot of homeowners right now that are looking to renew. again, like we've mentioned numerous of times, $1.4 trillion in mortgages starting to renew this year. And just in 2025 alone, there's over a million fixed rate mortgages that are coming up for renewal. So for a lot of these clients, there's a lot of uncertainty in that market. Now, I totally understand not doing a drastic cut of 0.5, 0.75, or even 1%, because we don't want 2020, 2021 happen all over again, where the housing market spikes because money is becoming very cheap. But I do believe that a slow cut would have been, the bigger assist here with helping the ease tensions in the current real estate market.
Everything is just so up in the air for sure right now. Now, I want to flip this over and let's talk about what's really happening on the ground. Mortgage delinquencies, they might still be low in absolute terms, just 0.20% nationwide, but that climb from 0.14% in 2022 is a flashing yellow light. And in Ontario, it's more like red. Are we painting that red flag green at this point? I mean, a 90% spike year over year? That's not noise, that's a signal. Over 11,000 homeowners fell behind last quarter alone. So the narrative that house loans are holding up under higher rates is starting to crack. How should investors be reading this? Is this the early tremor before broader credit stress starts surfacing?
Yeah, so the way I would read this and the way I would always express to future home buyers as well as investors is to understand, where the news is coming from. And what I mean by that is a lot of these updates are from the last 90 days. A lot of the times they're 6 months delayed. And why that happens is because when you go to delinquency with a Schedule A or Schedule B bank, they are a little bit slower when it comes to pushing a property to a power of sale and really ringing the bell. So as an example, right now, if someone was delinquent as of January, they have up until 6 months till the bank may start that power of sale. So we're actually not seeing that news or hearing about that news until June and actually seeing the effects until September. So that's where investors need to be weary right now, is that this news that they're hearing is from 3 to 6 months ago. So the last 90-day history of mortgage delinquency is up 0.22%. But again, that stems from December, January, and February, maybe a little bit into March. So I feel like the worst is still yet to come, given that, we haven't even seen the uptick in mortgage renewals yet. Again, what a lot of people have to realize is that the rates were finally cut back in 2020, starting in March 15th, 2020, when the world was finally shut down. Whereas in February of 2020, we were still at 4.1%, 3.9% mortgage rate range. So that means a lot of those renewals, majority of those renewals are still yet to come. So we're still yet to see the pressures that these new renewal rates are going to have on the broader market, especially in markets like Ontario and BC.
Okay, so here's the real tension then. Even with the Bank of Canada holding rates, homeowners renewing in 2025, as you said, they are walking straight into a payment shock. If we look at this, 1 million fixed rate mortgages are set to reset, many at rates double what they locked in during the pandemic, as you said. And it's not just about mortgages. I mean, here in BC, the 90 plus day non-mortgage delinquency rate jumped 21.6% year over year, pointing to financial strain that's spreading beyond housing. So is this a temporary adjustment phase, you think, or are we starting down the early innings of a consumer credit unwind?
I think, unfortunately, not the fear monitor, we are staring down a consumer credit unwind for a temporary period. I think, it's still yet to be worse to come before we could break out of this. I think there needs to be a lot of adjustments when it comes to these rates, because again, those rates we had in 2020, 2021, those are once every 10 years, once every 15 years. For some home buyers, it was once in a lifetime that they've seen those rates. The first time in their lifetime they'd seen those rates. And to give you an idea, taking a $1 million mortgage back in 2020 or 2021 at those under 2% rates, and now coming to renew just over 4%, a lot of clients are seeing a payment increase of over $2,000 to $2,500 per month. And that's a huge shock. Yes, there's stress tests in place, but that changes a family's economic outlook and what their monthly budget has to be. $2,500 is no joke. And in many years before, that was like buying an additional property to have in your portfolio. Now you have that payment increasing just on that one property.
Okay, so taking a look at sales and outlooks then, let's flip over there then. Home sales in March just hit their lowest level for that month since 2009, down nearly 5% from February and a full 20% below the November peak. That's not a cooling, that's a cold snap. So even with the rate hold in play, buyers are staying on the sidelines right now. Is this an economic anxiety happening at work here, or is the real estate market starting to reflect something deeper about household balance sheets and investor sentiment, really.
Well, I think what's happening is a lot of clients that are looking to sell are still hoping or wishing that it's a seller's market like it was in the early pandemic years leading off into the late 2023. And now we're sort of seeing that balance between the prices where it is a buyer's market right now, especially in Ontario, especially in BC. And the sellers have to understand it's not a seller's market anymore. They can't have these high prices that they're expected to get. We're saying, my neighbor sold for X amount of dollars back in 2020 or 2022. There needs to be a realization. I think that's what the standstill is right now. So 2025 started off where a lot of clients thought they were able to sell their properties for a lot higher price. And you have a lot of buyers that understand that the values are not there anymore and that the prices do need to fall. So right now, I feel we are at a standoff between buyers and sellers, but we definitely are in a buyer market, especially again in two markets, major markets in Canada, such as Ontario and BC. And what we have to understand as well is that there's also over 77,000 condos for sale in Ontario right now. So it's a huge other crisis that we could discuss definitely on a later date as to what's going on with all these pre-construction condos that were built. And the values are just not coming in anymore. And why builders have now stopped and pulled out from starting digging, putting the shovels in the ground to build any more new pre-construction properties, as there's been this massive slowdown. So I think there definitely needs to be at least a 6 to 9 month adjustment where we actually see the true value in homes again and move into that balanced market versus going from, again, the sellers thinking they're in the seller's market and buyers not, but they're in a buyer's market.
I mean, and that's really the case right now, is we have such a housing crisis in Ontario, and definitely in BC as well, and they're building and building and building. However, the financing and all of that from people that are wanting to buy these, it's just like you said, it's not there. They're scarce right now. I mean, the sales to new listings ratio has cratered to 45.9%. That's the weakest reading since the financial crisis. Now, Ontario, you're at 39%, deep in buyer's market territory, while Alberta and Quebec, they're holding up with seller's market dynamics. So we're not just looking at a soft patch, we're seeing a fractured market. Does this split tell us more about regional economic resilience, or is this masking a broader weakness that's just hitting at different speeds?
I think it's just regional economic weakness, like you discussed. So again, the markets that really popped in the last few years have been the BC and Ontario market. Obviously, the more desirable ones, larger urban areas, and a lot faster when it came to development. Now, Alberta has catched up in recent years with starting a lot of development. I've been to Calgary many times in the last couple of years and seen a huge change to their skyline. So for them, their market's actually up right now. They're up, I believe it was 5.7% year over year, which is massive when you're looking at the whole country as a whole. But the reason being is that their prices were still very affordable with the same income people were earning most likely all across Canada. And that's what we're seeing right now. We like to say in our business, a mass exodus of Ontarians and clients from British Columbia as they're like, I need to get out of here. We need to bring affordability back. I want to get a bigger property. I want a bigger piece of land. I need to move to Alberta, look at a new build that for 3,000 square feet, I'm getting a property for maybe under $1 million. Whereas over here, you're getting a 500 square foot condo for just under $1 million. So it really comes down to when is enough for consumers, and does it really matter anymore where they're staying, especially with all this work from home and movement across the country with different job opportunities opening up. You'll see that mass exodus from these more expensive regions like Ontario and BC, and you'll see clients moving into these newer regions and these newer properties where they're seeing a lot of economic growth and the potential for the property to increase in value in the next 10 years versus have a decrease before it gets better.
Yeah, that's understandable. I do remember the time where oil was completely booming in Alberta, and so everyone was rushing over there. Teachers were rushing over there, nurses were rushing over there, and then it sort of fizzled out, and now it's come back because as you said, I mean, with work from home, from all the different opportunities that we have on the work basis, it doesn't matter which province. You're going to go where your dollar is going to go the furthest. So that's a really great point. We are in some interesting times right now, Michael.
We definitely are, and there's a lot of uncertainty. And I think the main thing we need here, if the Bank of Canada is not going to have a assistance with the rate shift, is the big five banks and every other creditors out there need to come out with new products, new solutions to adjust. These products have been around for last 50, 60, 70 years, however long they've been offering mortgages for. And eventually, just like technology, you have to adapt. And I feel like these products need to adapt. And we are seeing that in the first time home buyer market now with an increase from 1 million to 1.5 million for less than 20% down. But I think broader changes need to happen when it comes to the stress test and the amortization rates, as we are in for a lot of uncertainty with, again, 1.4 trillion mortgages starting for renewal this year, a lot of variable rate mortgages in negative amortization, and a lot of speculation on affordability. And I think also those product changes will help the bank with any credit pressures they're facing. At the end of the day, they don't want to go delinquent. The bank is not in the real estate game. They do not want to take over properties. They want to do everything they can to have their clients paid and keep the money in their protection at bay.
Well, time will tell then, Michael. Thank you so much for joining me and chatting with me again.
Thanks for having me, Lindsay, as always.
So be sure to check out some of our other conversations around the BOC cuts, and shameless plug here, check out our podcast Contributors Corner, where Michael and I dissect the ins and outs of different sectors and how they affect your portfolio. I'm Lindsay Melchick with Stockhouse Publishing. Thank you for joining us.